All right, guys, let's quickly take a look at the updated CFTC data that we got on Friday. Always worth remembering when we look at data like this, that it's lagged information, right? Even though we got this data on Friday, it doesn't show us updated positioning information up until Friday. It only shows us updated positioning info from for the relevant week's Tuesday. So that means that the information we're looking at right now only shows us the price action up until last week, Tuesday the 4th, meaning everything that happened between Wednesday, Thursday, and Friday won't be reflected in this information. It's especially important like in weeks like last week, because we know we had a massive move to the upside in the US dollar on the back of the NFP. So that is why it's so important. It means that this data we're looking at right now will only show us updated info until Tuesday the 4th, right over here, which means everything that's included after that won't be reflected in that data. So very important to always keep that in mind. Now, in terms of the update, what's the most important things or biggest insights that we can get from this data? I think firstly, let's talk about the US dollar, because the dollar has been a preferred short for us for the past, what's it been now, 4.5, 5 weeks. The reason for that wasn't just positioning information. Positioning was definitely one of the reasons why we liked shorting opportunities in the dollar, but there were other reasons why we liked the dollar lower. We had the Fed's reluctance to shift more hawkish. We had CPI data which continued to trend lower. We had a massive amount of downside surprises in US economic data. I mean, if I just quickly bring up the steady economic surprise index here for the US, just give me a quick second just to refresh everybody's memories. Where's that chart? Here we go. If we take a look at that chart, we saw a big move to the downside. Downside in economic surprises, right? We had continuous downside surprises in hard as well as soft data. That was the reasons why we liked, some of the reasons why we liked the dollar lower. Obviously, positioning being so stretched to the upside at the time just made it a much simpler option to look for shorting opportunities. Now, coming into this week, there's a lot of two-way risk because we're going into CPI, we're going into FOMC, and there's a lot of nuances to understand about those. About the risk events. You know, they can create some pretty confusing price flows, and we'll discuss why in a little bit later in the week ahead video, as well as the previews that we'll do. But the bottom line is positioning isn't as stretched as it was anymore. Now, yes, keep in mind this chart will not reflect the move we had to the upside on Friday, but I would be very, very surprised if the dollar positioning suddenly went back into massive stretch long territory. You know, we might be seeing a move back to the upside a little bit, but I doubt whether it's going to be a massive move to put it into stretch territory again. So I think what that means for the dollar in a week like this is that it's going to be subject to whatever happens to CPI and FOMC. And I think we'll be able to trade it both ways. However, because we've had this massive downside surprise for quite a while in US economic data, and obviously with the big change we saw on Friday with NFP, big upside surprise in NFP. Because of that, because we're going into the FOMC, I would not be surprised to see the dollar stay supported running into the CPI print on Wednesday. And depending on what happens there, obviously potentially running into the FOMC as well. So just keep that in mind. I don't think the same edge that we were looking at for the US dollar a couple of weeks ago, I don't think we have that same edge for the dollar going into a week like this. Now, other currencies to keep in mind, the Aussie dollar, we've spoken about this quite a lot. We still like the Aussie lower from a sentiment point of view. The reasons for that, you know, things like copper, not the only reason, but one of the reasons. Copper continues to push to the downside, seeing a little bit of a recovery move, to be fair, today. But that overall push to the downside has been one of the reasons why we've been looking for more downside to be expressed for the Aussie. The Aussie gave us a fantastic opportunity to short on Friday, obviously out of the jobs data. You guys will recall looking at our event preview plan for the scenario plan for Friday. Aussie short was one of our favorites if we got an ideal hawkish outcome, and it provided us with just a fantastic opportunity to short. Now, to be fair, you could have chosen anything versus the US dollar. It would have been a good trade anyway, but the Aussie remains one of my favorite currencies on the short side right now. Not just because of things like copper, but because of all of that rate repricing that the markets, you know, got all excited about a few weeks ago. We were trading the Aussie higher, 7 weeks ago on the back of a view that the markets will need to reprice rates higher. Once the rates were repriced higher and the Aussie rallied as a result of it, I just think it's in the price right now. You know, the same reason to have bought the Aussie 5 weeks ago just isn't the same reason today. It's not a good enough reason because it's already reflected in the price, or should be reflected in the price. So still looking for shorting opportunities for the Aussie. We do have jobs data coming up a little bit later in the week. So my preference there would be to look for shorting opportunities in the Aussie if we get really bad data. I won't be looking to buy it if we get good data coming out of the jobs print. I am currently still short the Aussie versus the Kiwi dollar, which is also stretched long here a little bit more than the Aussie, but I see no reason to close that trade right now. The reasons why I like the pair lower is still very much intact. We do had the RBNZ shifting a lot more hawkish than what the markets had anticipated just a couple of weeks ago. And I would expect that trend to continue for the most part. Obviously, if the jobs data for the Aussie comes in super hot this week, then yes, the pair could push up. But I'm comfortable letting the rest of my position run in the Aussie Kiwi and seeing what we can squeeze out. Not too concerned about the Kiwi positioning from that point of view. Now, another currency that we do just need to keep in mind here is the Swiss franc, or currencies, is the Swiss franc and the Canadian dollar. When it comes to the Swiss franc, even though we were mostly bearish this currency running from January all the way up to May, and even though that was, you know, the right trade from a fundamental point of view, we got very patient with looking for Swiss franc shorts about 3-4 weeks ago now. The reason for that was mainly from a positioning point of view, saying that, you know, at these types of stretched levels, it's just not attractive to try and short the Swiss franc, even though we were bearish the currency. What did change though a week and a half ago is the hawkish comments that we got out from SNB's Jordan, where he basically came out saying that the bank is getting more concerned about inflation. They're getting concerned about a higher neutral rate in the future as well. And the CPI data that we got last week will give them absolutely no confidence that inflation is moving in the right direction, because it came in flat, came in exactly in line with prior at 1.4%. That still makes me very cautious on the Swiss franc, and if anything, it gives me more of a short-term upside bias right now from a pure positioning point of view, because if the inflation data doesn't give the bank confidence that inflation will stay low, if they still think there's a risk for it to rally, then they might put it in a little bit of a pause in their foreign currency reserve buying, which is an attempt to keep the Swiss franc weaker, right? So if we quickly take a look at this is very important. Let me just quickly bring this up. Here we go. If we take a look at the currency reserves for Switzerland, we can see that starting to push a little bit lower, right? So it basically coincides with the exact commentary we heard from Jordan, and that means that, again, in the short term, we probably want to be more bullish, something like the Swiss franc, especially given positioning as well. So that's just important to keep in mind for the currency. Now, another one that we need to talk about here is the euro. The euro was massively stretched on the short side a couple of weeks ago, but the markets have steadily changed that positioning by quite a bit. Basically mirror image of the dollar aggregate. Now, the challenge with the euro, obviously, in a week like this is that, firstly, the markets have well reflected the change in sentiment that we had in the euro on the back of better than expected data. The fact that the markets aren't as aggressive in their ECB views anymore, not as dovish on the ECB anymore. The markets have reflected that view adequately. We saw a lot of upside in the euro across various pairs in recent weeks. However, the weekend's issues from a political point of view does put the euro at a bit of a disadvantage. The one thing that the euro really doesn't like is political uncertainty. So the fact that we had that snap election called from Macron, that does pose a little bit of a risk for the euro. And going into a week like this, where we wouldn't be surprised to see something like the dollar strong running into CPI, I think that puts some downside pressure on the euro. So that is definitely something just worth keeping in mind. I don't think there's a positioning edge anymore here for the euro. I think that has played out. And that means that, with only politics in mind, and after that hot NFP print on Friday, it looks like there's more of a short-term downside risk, if anything, for the euro. So that's just an important update for the euro from a positioning point of view. Now, some of the other markets that we're looking at from a positioning point of view is commodities, as usual. Take a look at this gold chart. I mean, wow. We looked at this last week where this thing ramped up all the way to here. Now, what we said on Friday, going into the NFP, we said, okay, because positioning is so massively stretched, if we did get a massive hawkish outcome, the ideal hawkish outcome, we would have looked for, obviously, like we did, Aussie dollar shorts, which we traded. We could have looked for Aussie CAD. I didn't trade that because the Canadian jobs data didn't surprise meaningfully enough to the downside. The other option was gold downside, given positioning, right? So look at what happened to gold on Friday. It was a massive move to the downside. Where's my gold chart? Massive move to the downside, moving into that key level of support we were looking at on Friday at around that 2,300 level. Look, when it comes to gold, if positioning looks like this, with a dollar that is expected to remain strong, or at least a good probability for the dollar to remain strong, for yields to remain high, I think there's more downside risk for something like gold. Obviously, this can change going into CPI. It can change coming out of FOMC. But right now, with positioning this aggressive, I mean, you don't get to see charts like this every day. This is very stretched positioning. I'm not trading gold right now, as you guys know. But for those of you who are trading this and have exposures running, it's well worth noting the risks here. This is looking fairly aggressive from a positioning point of view, and that is just worth noting. The other one, which is, I mean, we've spoken about this so many times, I'm not going to bore you guys with all of the details, is just copper. Still massively stretched here to the upside, but we have, to be fair, started to see some of that unwind already over the course of the last few weeks worth of price action. But interestingly, despite the fact that prices have gone from 5.17 all the way down to, what was the low we got into earlier at 443. Despite that, positioning barely changed. Now, yes, it's possible that this might reflect a little bit lower because it only reflects data up until Tuesday. But, if you compare where we were back on Tuesday, this is where we were on Tuesday. So we're not massively lower compared to where we were Tuesday. You would have expected to see this type of change in the price to have shown a bigger reduction in long positioning, and the fact that it hasn't still makes me a little bit cautious here for something like copper. So that's just worth keeping on the radar in a week like this. So that's just a quick update in terms of positioning information from an actionability point of view. I think the most attractive currency or most attractive asset to look at here in a week like this would be Aussie dollar downside if we get massive disappointing data. Alternatively, if you're a commodity trader looking at possible continuation for gold downside, if we get some really strong CPI data from the US or a very hawkish FOMC. So that's just a quick view of the CFTC data. Any questions on this, don't hesitate to let me know.